Most homebuyers think mortgage rates are the same for everyone, but that's not how conventional loans actually work. When a lender prices a mortgage that will be sold to Fannie Mae, they use something called loan level price adjustments, also known as LLPAs. These are risk based pricing adjustments based on factors like credit score, loan to value ratio, property type, occupancy, loan purpose. These adjustments can change the cost of your mortgage by thousands of dollars. In this video, I'm going to show you exactly how conventional loans are priced using the actual Fannie Mae LLPA matrix. And we're going to run real scenarios comparing a 700 credit score versus a 740 credit score for three property types: a single family home, a condo, and a 4-unit property. And then we'll do the same comparison for a cash out refinance at a 75 loan to value. Loan level price adjustments are essentially risk premiums that lenders must apply when delivering loans to Fannie Mae. Every loan starts with a base market rate. Then adjustments are added depending on the risk profile of the loan. Those adjustments can either show up as higher interest rates or additional discount points. And the key thing to understand is these adjustments stack together. So the final mortgage pricing depends on multiple factors combined. The biggest drivers are credit score, loan to value ratio, property type. Let's start with a purchase example. We'll assume the borrower is buying a $700,000 property. They are putting 20% down, which means the loan to value ratio is 80%. That gives us a loan amount of $560,000. Now we're going to compare two borrowers. Borrower A, that has 700 credit score, and borrower B, that has a 740 credit score. Then we'll compare three property types: single family, condo, 4-unit property. First, let's look at a single family primary residence. According to Fannie Mae LLPA matrix at 75 to 80% LTV, the credit score adjustments are: for a 700 to a 719 credit score, the adjustment is 1.375%. For a 740 to 759 credit score, the adjustment is 0.875%. So right away, we see a difference. The borrower with the 700 score has a 1.375% pricing adjustment. The borrower with the 740 score has a 0.875% adjustment. Let's convert that into dollars. So a loan amount is $560,000. 1.375% equals $7,700 in pricing adjustments. 0.875% equals $4,900. That means the lower credit score borrower is paying about $2,800 more in loan pricing. And this is before we even consider property type. Now let's run the exact same example for a condo purchase. Condos have an additional adjustment in the LLPA matrix. At a 75 to 80% loan to value, condos add 0.75%. So now we stack the adjustments. For the 700 credit score borrower, credit adjustments of 1.375% plus the condo adjustment of 0.75 equals 2.125%. On a $560,000 loan, that equals roughly $11,900 in pricing adjustments. Now let's look at the 740 borrower. Credit adjustment 0.875%, condo adjustment 0.75%, total adjustment 1.625%. That equals roughly $9,100. So the difference between these two borrowers is now about $2,800 again. But the overall pricing is higher because condos carry additional risk. Now let's look at a 4-unit property. The multi-unit properties also have additional pricing adjustments. According to the matrix, at 75 to 80% LTV, 2 to 4-unit properties add 0.625%. Let's stack those adjustments. For the 700 credit score borrower, credit adjustment 1.375% plus the 4-unit adjustment of 0.625% equals total adjustments of 2%. On a $560,000 loan, that's roughly $11,200. Now for the 740 borrower, credit adjustments of 0.875% plus the 4-unit adjustment of 0.625 equals total adjustments of 1.5%, which equals about $8,400. Again, we see the credit score difference alone creates about $2,800 in pricing difference. Now let's look at a completely different scenario, a cash out refinance. Cash out loans carry much higher risk adjustments. We're going to assume the loan amount is $525,000 and a loan to value of 75%. Again, we'll compare 700 credit score versus 740 credit score. According to the Fannie Mae matrix, a 75% loan to value for a cash out refinance, the pricing adjustments are significantly higher. For a 700 to 719 credit score, the adjustment is 2.625%. For a 740 to 759 credit score, the adjustment is 1.625%. Now let's translate that into real dollars. Loan amount is $525. For the 700 borrower, 2.625% equals about $13,800 in pricing adjustments. For the 740 borrower, 1.625% equals about $8,500. That's a difference of over $5,000 purely based on credit score. And remember, this is before additional property adjustments. This is why cash out refinancing tends to have higher rates than purchase loans. There are three major takeaways from this pricing model. First, credit scores has a massive impact on mortgage pricing. Even a 40-point difference can change loans cost by thousands of dollars. Second, property type matters. Condos and multi-unit properties carry additional risk adjustments. And third, loan purpose matters. Cash out refinances are priced significantly higher than purchase loans. All of these adjustments are built into the Fannie Mae pricing model. If you're planning to buy a home or refinance and want to understand how your credit score and property type will affect your mortgage pricing, the smartest first step is getting pre-approved. That way you can see exactly what your loan pricing would look like before you start shopping. And if you found this breakdown helpful, make sure to subscribe because I post weekly videos explaining how mortgage financing actually works behind the scenes.